Welcome to video T2G on tax rates. Considering how much time we've spent around tax rates previously, it's hard to believe there's more. But there is! How exciting! We revisit tax rates again to see a few more perspectives and to provide additional opportunities to practice with income taxes. Oftentimes you'll hear a politician say he or she is going to simplify taxes by reducing the number of brackets. You're going to see by the end of this video that frankly, changing the number of brackets does very little to simplify taxes for the average American. If we have 5 brackets or 30, a taxpayer will always only look at one line to compute their tax. And so having fewer brackets does little to simplify compliance. That is all done in the way we calculate the tax base. That's where the real simplification is. In any event, let's go back to Manny and Luke again. Recall that Manny has $100,000 in taxable income and Luke only $10,000. However, now let's assume Manny is also lucky enough to generate $10,000 in tax-exempt income. Good on you, Manny. The tax liability for both is calculated exactly as it was in the previous video. If you did not compute these amounts last time, I strongly suggest you go through the motions with your calculator. After all, practice makes perfect, and I guarantee you'll be doing this on a quiz or exam. Assuming you all calculated the taxes just fine, let's look more closely at Manny's situation. I bet something that we all omitted from our computation was that Manny also had $10,000 taxed at 0%. Remember, he had $10,000 worth of tax-exempt income. Note that when we use either the marginal rate or the average rate, that 0% is not captured anywhere. What if instead of Manny, we had Crazy Manny? And Crazy Manny had $10,000 of taxable income and $90,000 of tax-exempt income. Now Manny's tax and average rate would be the same as Luke's, 10.1%. But does that capture Manny's economic condition? Would you say that Crazy Manny's tax burden of 10.1% on $100,000 of income is the same as Luke's? To better capture Crazy Manny's situation, we use what's known as the effective tax rate. The effective tax rate is tax divided by total income, not just taxable income. Now we see that Manny's tax rate is 1.1% because he was able to characterize so much of his income at the 0% tax-exempt rate. Maybe Crazy Manny isn't so crazy after all. But we should not throw out the average and marginal rates as meaningless. In fact, marginal rates are one of the most meaningful rates used in tax planning because they are more capable of predicting the future. Strong in the tax force is this one. Let's use an example to see how that works using Manny, regular Manny, not Crazy. If Manny, and let's call him New Manny, is considering an investment that he expects will pay him $50,000 extra income, how much can New Manny expect to receive after taxes? Here, the average and effective rates are meaningless. They include income brackets below New Manny's current income level and would skew the number downward. Instead, we can simply recalculate New Manny's income and taxes using the tried and true method we always have. Practice along with me. New Manny has $150,000 of income. We go to the income tax tables and take the excess over $84,200, multiply that result by 24%. Then we add the table amount of $14,382.50 for a total tax of $30,174.50. We can now compare Manny's old after-tax cash flow with his new after-tax cash flow. And we can see that Manny is $38,000 to the better. Or we can use the shortcut method we covered in a previous video, which says that Manny is in the 24% bracket and thus his next dollar of income will be taxed at 24%. If we invoke our well-known formula, of after tax equals pre-tax times 1 minus the tax rate, we get, voila, the same 38,000. Now is when we say, I love the marginal tax rate. Of course, this method has limitations. What if New Manny's investment was expected to pay $150,000 of additional income? If we use the long method, which you should practice along with me, when you look at the tax table, you'll see that the total taxable income of $250,000, Manny has migrated into the 35% bracket. Now, I don't feel too sorry for Manny because he keeps all the income he already had at the lower brackets. And I'd always rather have 65 cents per dollar than nothing. Well, I guess it's safe to say I'm not a substitution effect taxpayer. In any event, we take the $250,000 and subtract the bracket threshold of $204,100. That result is multiplied by 35%, to which we add the table amount of $46,628.50 to get the total tax liability of $62,693.50. We had previously calculated Manny's after-tax cash flows as $81,825.50. And now, after the additional $150,000 of income, that rises to $187,305 for a difference of just over $105,000. However, using the shortcut method, we get $97,500, and the amounts do not agree. In this case, New Manny suffers from what is commonly known as bracket creep. The additional income pushes his income into 3 new brackets. And so the simple effective tax rate method does not capture that his marginal tax rate is partly at 24%, partly at 32%, and partly at 35%. Bigger swings in income will often require the long method to accurately predict expected after-tax cash flows, so always be aware of the bracket creep. This makes the technically correct formula for the marginal tax rate as the change in tax divided by the change in taxable income. This chart shows how Luke, Old Manny, and New Manny's income can be segregated into the different tax rates. Note how New Manny has a chunk of income in the 24, 32, and 35% brackets, as denoted by the green, red, and blue increments. If you look really closely, you'll see that Luke has just a sliver in the 12% bracket. As we've discussed, individual income tax brackets are used in such a way that the benefit of the lower brackets accrues to both rich and poor. For example, Bill Gates may have annual income of hundreds of millions, but he still benefits from paying tax at 10% on the first $9,700 in 2019. Thus, weep not for bracket creep. The rate of tax on those first increments of income is still taxed at the lower rates. This keep the benefit of lower rates approach can be contrasted with pre-2018 corporate income tax rates in the U.S. So using the 2017 rates here as an example year, and note that corporate rates are typically extremely stable and are generally not updated to reflect inflation. However, it is not the 2017 rates themselves that I wish to draw attention to, but rather the construction of the table. Note how the rates are progressive, starting at 15%, going up to 25%, and then to 34%, and then to 39%. But then, wait one second, they go back down to 34%. Huh? Okay, well, wait a second, then they go back up to 35%, and then to 38%. Oh, I was starting to think something was wrong, but wait, then they go back down to 35% again. The corporate tax rate tables are designed to eliminate the benefit of the lower tax rates once a certain threshold is crossed. For example, the 39% rate is designed to eliminate the advantage of the lower 15 and 25% brackets as you work your way between $100,000 and $335,000 of taxable income. Starting at $335,001 and going all the way to $10 million, the tax rate is actually a flat 34%. Go ahead, take an amount, calculate the tax, and you'll see, check the math, it's true. Then the rate creeps up to 35% for anything above 10 million but below 15 million. And then the 38% bracket eliminates the benefit of the lower 34% bracket until you get to 18,333,000, at which time the tax is now a flat 35%. Again, feel free to check the math and you're going to see. So corporate taxpayers suffer bracket creep disadvantages, whereas individuals do not. Okay, that was a great lesson in the progressivity of corporate tax rates. But guess what? It's all gone. The new corporate tax rate structure starting in 2018 is a flat 21% for all corporations, big or small. Okay, one last thing about corporate taxes. In your basic financial accounting course, you should have learned that businesses prepare financial statements in accordance with generally accepted accounting principles, or GAAP. GAAP has a unique way of computing financial statement tax expense that is only partially based on what that same business records as tax on its actual tax return. Let's use an example to explain why that might be. Take a moment to read about Firm X. So if we look at Firm X's financial statements, we'd see that X made pre-tax profits of $60 in both years 1 and 2. However, if we look at X's tax return, because tax rules and accounting rules differ, X generates taxable income of $100 in year 1 and only $20 of taxable income in year 2. Note that over both years in total, the pre-tax income and taxable income are the same, so it's really just a matter of timing. X could not recognize the expense in year 1 for tax purposes, but could for accounting purposes. I assure you that situations like this are very common. So if we now try to use the tax return amounts to record actual tax expense, you'll see that net income after tax in year 1 is $39, and in year 2, $56. Now you have to ask yourself, did Firm X actually operationally perform at nearly double the rate in year 2 as in year 1? No, of course not. In fact, from an accounting perspective, Firm X was identical in years 1 and 2. And so the accounting Yodas at GAAP said, "Make no sense, these tax and income numbers do." Instead, they decided that a more meaningful tax expense would be one based on pre-tax income as reflected in the financial statements. And so instead, the financial statement presentation of tax expense is focused more on pre-tax book income than on the amounts from the tax returns themselves. Okay, why do I tell you this? Because when you're examining the financial statements of a business, do not fall into the trap of thinking that the tax expense on those financial statements is cash tax expense. It is not. Cash tax expense is in fact a required GAAP disclosure and can often be found on the statement of cash flows or in the footnotes. And with that, we come to the end of video T2G on tax rates. We also bring to a close our coverage of Chapter 2. Our next video starts Chapter 3 by reviewing the topic of time value of money as it relates to taxes. If you know nothing about time value of money, I strongly recommend you watch the Khan Academy videos to remind yourself. This is not a course on finance, but some fundamental finance skills are necessary to better understand tax planning. Thanks for watching.
It's too big.
Size matters not. Look at me. Judge me by my size, do you? And where you should not. For my ally
Is the Internal Revenue Code.
and a powerful ally it is. Life creates it. Makes it grow. Its energy surrounds us and binds us. Luminous beings are we, not this crude matter. You must
Feel the code around you.
here, between you, me, the tree, the rock, everywhere. Yes, even between the land and the ship.